Welcome back. Something happened in the silver market not too long ago that genuinely stopped me mid-scroll when I first caught it. Silver dropped, and not in the slow, grinding kind of way that makes you think the market is just taking a breather. This was a sharp, deliberate-looking move down, the kind of drop that makes experienced traders raise an eyebrow. But here is the part that really caught my attention, the part that made me want to dig into this and bring it to you today. It happened before the CPI inflation report was officially released to the public, before you and I could open our phones and read the numbers, before the headline crossed any news ticker, before any journalist had typed a single word about what the data showed. Silver had already moved, significantly. And when you see something like that, when a market makes a major move before the information that should have caused it is even public, you have two choices. You can scroll past it, chalk it up to coincidence, and move on with your day. Or you can slow down, look a little more carefully, and ask the question that actually matters. What is really going on here, and what does it mean for people like me? That is exactly what we are going to do today. My name is John Smith, and welcome back to the channel. If you have spent any time here before, you know this is not a place for panic content. It is not a place for conspiracy rabbit holes or doom and gloom headlines designed to make you feel scared. What this channel is about is taking genuinely complex, genuinely important things happening in the financial world and breaking them down in a way that actually helps you think more clearly about your money. So today we are going in deep on the silver crash before the CPI release. We are going to talk about institutional pre-positioning, what liquidity rates actually are and how they work, why the silver market is particularly vulnerable to this kind of dynamic, and most importantly, what all of this means for everyday investors who are just trying to make smart decisions with their hard-earned money. Let's start by building a foundation, because context is everything here. We are living in a financial environment where the CPI report, the Consumer Price Index, is arguably the single most consequential piece of economic data released on a monthly basis. This number is the government's official measurement of how much prices across the economy are rising. It tracks the cost of groceries, rent, medical care, gasoline, clothing, and hundreds of other things that make up the daily expenses of American households. And every single time this number is released, financial markets react, sometimes dramatically. Bond yields move, the stock market swings, currency values shift, and commodities, including silver and gold, reprice based on what the inflation data implies for the broader economic picture. The reason CPI carries so much weight is that it directly influences what the Federal Reserve is likely to do with interest rates. The Fed's job, at least one major part of it, is to keep inflation under control. When inflation runs hot, the Fed is under pressure to raise rates or keep them elevated for longer. When inflation cools, the Fed has more room to cut rates and stimulate growth. And since interest rates affect the cost of borrowing for literally everything, mortgages, car loans, business investments, government debt, a single CPI print can send ripples through the entire financial system in a matter of minutes after it is released. So when we talk about an asset moving before CPI is released, we are talking about something moving before arguably the most market-moving piece of data in the monthly economic calendar. That is why this matters. That is why it is worth your time to understand. Now let's talk about where silver fits into this picture, because silver has a genuinely interesting and somewhat unique relationship with inflation data. Silver is what market professionals sometimes call a dual asset. It lives at a crossroads between two very different worlds. On one side, silver is an industrial metal with enormous real-world demand. Every year, massive quantities of silver are consumed in the production of solar panels, semiconductors, electric vehicle components, medical equipment, and a growing range of clean energy technologies. This industrial demand means that silver's price is tied in part to the health of the global economy and the pace of manufacturing and technological growth. On the other side, silver also carries a long historical reputation as a store of value, a real, tangible asset that holds worth when paper money comes under pressure. When people worry about inflation eroding their purchasing power, some of them turn to silver as a hedge, the same way they might turn to gold. This dual nature makes silver's relationship with inflation data genuinely complicated. A hot CPI report doesn't just mean one thing for silver, it means several things simultaneously, and they don't all point in the same direction. Higher inflation might, in theory, support silver as a hedge, but higher inflation also pushes the Fed toward tighter monetary policy, which means higher interest rates, which means the opportunity cost of holding silver, an asset that pays no yield, goes up. When you can earn meaningful returns sitting in a treasury bond or a money market account, the case for holding a non-yielding commodity like silver gets harder to make in the short run. And it is this interest rate dynamic, specifically what economists call the real interest rate, that tends to dominate silver's short-term price action around CPI releases. Real interest rates, just to make sure we are clear on this, are what you get when you subtract the inflation rate from the nominal interest rate. If the Fed's rate is 4% and inflation is running at 3%, your real rate is about 1%. If inflation suddenly jumps to 5% and the Fed hasn't moved yet, your real rate briefly goes negative. And when real rates go negative, holding physical commodities becomes relatively more attractive, because at least they hold real-world value. But when a hot CPI print suggests the Fed will keep rates high for longer, real rates can rise on a forward-looking basis, and that puts pressure on commodities like silver. This is not a small or academic distinction. It is the core of why silver tends to sell off when inflation surprises to the upside. So now we have the setup. Silver is sensitive to CPI data in specific and important ways, and yet silver moved before the data was released, before anyone outside of a very small group of government statisticians knew the final number. So how does that happen? Let's break this down into the real mechanisms at work, because there are actually a few different things going on simultaneously, and understanding each one individually will give you a much clearer picture of the whole. The first mechanism is institutional prepositioning, based on data analysis. And I want to be careful here because this is the part that is easy to misconstrue as something more sinister than it actually is in many cases. Large institutional investors, hedge funds, investment banks, commodity trading firms, macro-focused asset managers do not just wait for the CPI number to drop and then react like the rest of us. They have entire research departments dedicated to building forward estimates of what economic data is likely to show before it is officially released. They are not guessing blindly. They are doing sophisticated analysis of leading indicators. Think about what goes into a CPI print. Before the official report comes out, there is a stream of other economic data that gets released throughout the month. Energy prices are tracked daily. Wage growth data comes from employment reports. Producer prices, what businesses pay for their inputs, are released in the PPI report that comes out a day before CPI. Regional Federal Reserve surveys give a read on business conditions and pricing pressures. Import and export prices are published, and there are private data providers that track things like grocery prices and rent growth in real time. An experienced economist who synthesizes all of these inputs can build a reasonably confident estimate of where the official CPI number is likely to land. Not perfectly, not with certainty, but with enough confidence to inform a positioning decision. Now here is what this means in practice. If an institution's internal models are telling them that the upcoming CPI print is likely to come in above consensus, hotter than the market expects, they will often begin reducing their exposure to assets that tend to suffer in that scenario. Silver is one of those assets. So they start selling, or they start building short positions in the days and sometimes hours leading up to the official release. This is not illegal. This is not insider trading, because the information they are using is publicly available. They are just better at analyzing it. But the effect on the market is real and visible. Prices start moving before the news is public, not because someone leaked the data, but because smart, well-resourced analysis is reaching a conclusion ahead of time. This is actually how financial markets are supposed to work in theory. The concept of price discovery, the process by which markets arrive at the right price for an asset, involves incorporating information as it becomes available. And leading indicators are information. The market pricing in expected CPI data before the official release is, in a technical sense, the system working correctly. But it creates a world where the price you see on your screen already reflects information you haven't had a chance to react to yet. And that can feel deeply unfair, even when it is technically legal. The second mechanism is where things get more controversial and honestly more interesting. This is what traders call a liquidity raid, and sometimes a stop hunt. To understand this, you need to understand a little bit about how most retail traders and smaller investors manage their risk. When you hold a position in silver or any traded asset, you are exposed to the risk that the price moves against you. To limit that risk, most traders set what are called stop-loss orders. A stop loss is an automatic instruction to your brokerage to sell your position if the price falls to a certain level. It is a safety net. If you buy silver at $30 and you set your stop loss at $27, you are saying, if silver drops to 27, get me out automatically so I don't lose more than I am comfortable losing. The problem is that stop loss orders are not invisible. In futures markets and in certain other trading venues, sophisticated participants can see or infer where large clusters of stop orders are sitting, and when you have millions of small investors and traders all using similar technical analysis strategies and similar risk management approaches, those stop orders tend to cluster at predictable levels, just below a recent price low, just below a round number, just below a key support level that everyone has been watching on the chart. A large institution, or in some documented cases, coordinated groups of traders, can recognize these clusters and deliberately push the price down to where those stops are sitting. It does not take as much capital as you might think, because markets become much thinner and easier to move in the period right before a major data release. Most careful traders pull their orders back when a big number is coming. They do not want to be sitting in a volatile market when CPI hits and the price swings 10% in 30 seconds. So the liquidity in the market drops dramatically in the pre-announcement window. And here is the thing about thin markets: they move more easily. The same amount of selling pressure that would barely nudge the price in a normal liquid market can cause a sharp, dramatic drop when there are very few buyers on the other side. So a large player pushes the price down into that cluster of stop-loss orders with relatively little capital. The stops start triggering. Now you have thousands of retail traders getting automatically sold out of their positions. Their forced selling pushes the price down even further. More stops trigger, the price cascades downward, and the large player who engineered this whole sequence has now cleared out a huge amount of retail positioning at a price they chose, and can now buy back at a lower level before the market normalizes. This is the stop hunt. This is the liquidity raid. And whether it happened exactly this way in the specific silver episode we are discussing, I cannot tell you with certainty, but the pattern, a sharp, exaggerated price drop in a thin pre-announcement market that then partially reverses after the data is released, is consistent with this kind of activity, and it has been observed and discussed by market practitioners for decades. It is not a conspiracy theory. It is a described and recognized phenomenon in commodity markets. The question is always whether any specific instance is intentional manipulation or just the natural consequence of thin liquidity and concentrated institutional selling. That line is genuinely hard to draw in many cases. Now I want to bring in the regulatory dimension here, because it is important and often misunderstood. The CFTC, the Commodity Futures Trading Commission, is the primary regulator overseeing futures markets where a large portion of silver trading happens. They have rules against manipulation. They have specific rules against a practice called spoofing, placing large orders with no intention of executing them purely to create the false impression of demand or supply, which then gets canceled after other traders have reacted. There have been major enforcement actions in precious metals markets. Several large banks have paid hundreds of millions of dollars in fines and settlements related to spoofing and related practices in gold and silver futures. This is not speculation. It is documented regulatory history. But regulation is inherently reactive. Regulators identify patterns after they have happened, investigate, build a case, and bring enforcement. By the time the case is settled, the market has moved on. New techniques have emerged, and there is a fundamental philosophical challenge in distinguishing between very smart, very aggressive trading and actual illegal manipulation. The CFTC does important work, but it is operating against markets that move in microseconds with algorithms executing millions of trades per day. Perfect enforcement is not realistic, which means the structural advantages that large institutions have over retail participants are not going away anytime soon. If you are still with me at this point, and I hope you are, because this next part is where it gets most directly relevant to you, let's talk about the practical implications for everyday investors. Because all of this history and mechanics is only valuable if it helps you make better decisions. So what should you actually take away from the fact that silver can and does move sharply before major data releases, partially driven by institutional pre-positioning and potentially influenced by stop-hunting dynamics in thin pre-announcement markets? The first thing to understand is that trying to trade silver around CPI releases as a retail investor is an extraordinarily difficult game. You are competing against people who have more information, faster systems, better models, and more capital than you. The window of opportunity around a data release is measured in seconds to minutes. High-frequency trading algorithms are executing in milliseconds. By the time you read the CPI headline on your phone and decide to act, the fastest institutional players have already made their move and are possibly already unwinding it. This is not the game you want to play, not because you are not smart enough, but because the structural advantages on the other side are simply too large. The second thing, and this is probably the most practically important, is understanding the difference between noise and signal. Short-term price moves in silver, even dramatic ones, are often noise. They reflect positioning, thin liquidity, technical stop triggers, and the short-term gyrations of a volatile commodity market. They are not necessarily telling you anything meaningful about silver's fundamental value or its long-term trajectory. The investors who consistently get hurt in situations like this are the ones who confuse noise for signal. They hold silver for the right long-term reasons, as an inflation hedge, as a small diversifying position in a broader portfolio, but they react to short-term noise with long-term consequences. They see the sharp pre-CPI drop, feel the panic, and sell at exactly the worst possible moment, handing their position to institutional buyers who are very happy to accumulate at temporarily depressed prices. This is worth spending a moment on because I think it is one of the most underappreciated sources of underperformance for retail investors across all asset classes, not just silver. The volatility itself is not the problem. Volatility is part of owning any real asset that trades on an open market. The problem is the emotional response to volatility. The brain registers a sharp drop as danger. The instinct is to get out. And in most situations in life, acting on that instinct makes sense. But in markets, the instinct to sell into a sharp drop is often exactly the wrong response, especially when that drop is driven by the kinds of technical and structural factors we have been discussing today, rather than by a fundamental change in the asset story. Here is something that I think about when a sharp, confusing market move happens. What has actually changed? Not in the price, not in the chart pattern, but in the underlying reality of the asset. Has something happened that makes silver fundamentally less valuable over the next 5 years? Has industrial demand collapsed? Has a new substitute been discovered? Has there been a fundamental shift in monetary policy that changes the inflation picture entirely? If none of those things have happened, and the price dropped because of thin pre-announcement liquidity and triggered stop orders, then the drop is noise. It is uncomfortable, temporary noise, but noise nonetheless. If your thesis for holding silver is a long-term one, and for most retail investors, a long-term perspective is the only realistic and sustainable approach to commodity investing, then short-term noise should not change your behavior. It might change your mood for a day or two, but it should not change your position unless something fundamental has actually changed. Now let me also give you the other side of this because I want to be fair and balanced. Silver is not without real risks that have nothing to do with institutional manipulation or stop hunts. It is a genuinely volatile asset. It can decline for extended periods even when the inflation backdrop is supportive, simply because of shifts in industrial demand or changes in investor sentiment. The rise of alternative inflation hedges, Treasury inflation-protected securities, certain real estate investments, commodities indices, means that silver competes with other options that some investors find less volatile or more straightforward. And the silver market's history is full of episodes, the most famous being the Hunt Brothers episode in 1980, where prices went to extreme levels and then came crashing down, leaving late investors with enormous losses. Silver can also be expensive to own in its physical form. Storage costs, insurance, the bid-ask spread when buying and selling coins or bars. In its paper form, through ETFs or futures, there are management fees and the complexities of how those products track the underlying spot price. None of these are reasons to automatically avoid silver, but they are real considerations that should be part of any thoughtful decision-making process. If you do hold silver or are thinking about it, the questions worth asking are, what is my time horizon? What is the size of this position relative to my overall portfolio? Am I holding this because I genuinely believe in the thesis, or because I read something that made me excited in the moment? Do I have a plan for how I will react if the price drops 30% over the next year? Will I hold? Will I buy more? Or will I panic sell? Having clear answers to those questions before you are in the position is enormously more valuable than trying to figure them out when the market is moving against you and your emotions are running hot. Hey, if you have made it this far in the video and you are finding this useful, and I genuinely hope you are, please consider hitting the like button and subscribing to the channel if you have not already. It costs you nothing, and it genuinely helps more people find this kind of content. And if you have questions about anything we covered today, the comment section is the best place to ask. I read them and I try to respond when I can. Let me bring all of this together now, because we have covered a lot of ground and I want to make sure the key ideas are clear. Silver dropped before the CPI report was released because of a combination of factors that, once you understand them, are not mysterious at all, even if they are frustrating. Sophisticated institutional investors were pre-positioning based on their own analysis of leading economic indicators, which suggested the CPI number was likely to come in hot. They started reducing silver exposure before the release, because a hot CPI print is, in most environments, negative for silver in the short run through the real interest rate channel. At the same time, the pre-announcement period saw dramatically reduced market liquidity as most careful traders pulled their orders back to avoid volatility. In that thin environment, selling pressure had an outsized impact on price. Stop-loss orders at predictable technical levels triggered, creating a cascade of forced selling that amplified the initial move, and by the time the official CPI number hit the wire and the broader public had information to react to, the biggest part of the price move had already happened. This is not a one-time anomaly. This is a pattern that has been observed repeatedly in silver and other commodities around major data releases. It reflects structural features of financial markets, the information advantage of large institutions, the dynamics of thin pre-announcement liquidity, the vulnerability of clustered retail stop orders that are not going to disappear anytime soon. Understanding these features does not make you immune to them, but it changes how you interpret them. It keeps you from making fear-based decisions based on what is often temporary, technically driven volatility, and it helps you stay focused on what actually matters for your long-term financial picture. The market is not perfectly fair. The playing field is not perfectly level, but it is also not perfectly rigged against you. There are real opportunities in markets for patient, informed investors who understand what they own and why they own it, who do not confuse short-term noise with long-term signal, and who have the discipline to hold their position through the kinds of manufactured volatility we discussed today. The people who consistently lose are the ones who are playing a short-term game they were never equipped to win. The people who consistently do okay, not perfectly, but okay, are the ones who invest based on clear thinking, appropriate diversification, realistic time horizons, and a genuine understanding of the assets they hold. That is what I hope today's video gave you a little more of. Clear thinking about a confusing market moment. I hope it helped you understand not just what happened, but why, and what it means in the context of how you approach your own financial decisions. Silver will continue to be a fascinating and sometimes maddening asset to watch and to own. The dynamics we talked about today are not going anywhere, but now you have a framework for understanding them rather than just being confused or frustrated by them. That is going to wrap it up for today on the channel. If there are specific topics you want me to dig into, whether it is more on commodity market mechanics, the inflation picture in 2026, how real interest rates affect different asset classes, or anything else in the finance and economics world, drop it in the comments. I take those seriously, and they genuinely shape what we cover here. Thank you for spending your time watching, and I will see you in the next one.